Yeah, people are talking to me about your keynote later on this afternoon.
Do they know what I'm going to talk about already?
I think we can preview it a little bit later on here. Just give them a taste, of course. But speaking of taste, let's talk about the bad taste left in investors' mouths because of Cyprus. What did you make of that situation?
I really don't care. I mean, Cyprus is a $10 billion problem. It's really something of concern. It has some symbolism impact on Europe, but it's not a really major economic issue. It's a $10 billion issue. It does remind us of the frailties of Europe. It does remind us that the European fix will be multiple years. But the essence of Cyprus is more symbolic. BlackRock is representing the Cyprus government, so I'm not permitted to talk too much about the specifics of it. You know, they'll come to some form of resolution, but it's really a debate upon, you know, whether you are going to have the EU becoming, you know, more controlling if there's going to be funding in Cyprus and how that funding will be. Who will bear some of the responsibilities? There are many rumors about who are the depositors in Cyprus, and many of the depositors of Cyprus are not EU members. They may be living elsewhere, maybe a little further east and a little north of Cyprus, and therefore bearing the cost on the depositors is an indication that you know, if we're going to bail you out, we're not just, you know, we're fine with bailing out EU members and EU depositors, but this is quite a bit different. Right.
So you don't care about Cyprus, but the markets did. I mean, did you see the sell-off that we saw around the world? I mean, here in Hong Kong, we're down to our lowest since early December, and really, it was a ripple effect around the rest of the world. You were calling for a sell-off, though, weren't you?
Yes, it was, but you know, I didn't think this was going to be the moment in which we were going to have the sell-off. My view on the sell-off is we've had a huge rally, and we're actually seeing quite a few clients take some chips off the table and reap some of the gains. And so, to me, this is just temporary. I think Cyprus is just one of the elements that people are saying, let me pause here, let me wait. And I think we're going through this digestive stage right now.
But were you shocked that they were trying to tax bank deposits? I mean, try to get the average man to pay up for their bailout, for the Cyprus bailout? Well, it's precedent-making. That's because, you know, people were concerned if this happens in Cyprus, I mean, what about my holdings elsewhere in the world? What about my bank deposits? Even people in America were questioning that. Can you believe it?
Well, we have insurance, so that will not happen the way it's been done. We've always prioritized the liabilities from depositors before in front of every other liability holder. And that's the same thing principally in Europe. And this is why the EU has stopped that plan. So let's get back to the prioritization of the depositors first in terms of liabilities. And so they tried it. It didn't work. Let's move on.
Okay. Well, let me just ask you one more question on Europe before we move on ourselves to other topics. Because last time that you were here, just about a year ago, we were talking about the European sovereign debt crisis. And, you know, fast forward a year, we're still talking about the debt crisis. Where are we in that cycle? Are we close to the end of this crisis? Are we in the middle? Are we just at the beginning?
We're in the, you know, using a baseball analogy, we're in the third inning. We have
6 innings to go. 6
innings to go. And this is a long process. Actually, the work that was done in Spain and Italy over the last year is very good. And actually, Spain has had now as a current account surplus. So there's been much improvement, and yet there's a lot more to do. You still have the instability of finances in France that we cannot underestimate how severe that could become. When the ECB created its OMT, they did that with the idea that we could firewall maybe Spain, possibly Italy. There's not enough money in Europe to ever go around if France remains in a path of having huge deficits and having huge imbalances of productivity. France is just not as competitive as Germany. And that remains to be a big issue. And you're seeing businesses moving out of France because it's so expensive to do business there. And so, you know, we are going to have, as I said, 6 more innings of evolving uncertainty. But hopefully, like the last year, we're going to have the pushes and the pulls. But you could say net, last year was a positive year in terms of the stabilization of Europe, the fixing Europe. But it's going to be with us for a long time.
Do you think we're in the midst of this correction that you've been calling for?
You know, we're definitely in a pause. We are seeing clients pausing now after a huge run-up. We had in the first 6-7 weeks of the year about $30 billion of inflows in equities. And in the last 2 weeks, we've seen it flat to modestly lower. Most of that money came in from cash, so it wasn't a reorienting or rotation from bonds to equities, which so many people talk about, which we can talk about later. It was really people putting money to work, and now some people are taking that money off. And depending on the economic information that we receive, we could be at the beginning of a 5% correction, or we're going to be in probably a prolonged 1 or 2 month pause, which I don't mind.
Right.
But I would say by year-end, equity market's going to be a lot higher.
Yeah. So. Now, in the fourth quarter, BlackRock reported some blowout numbers because people are buying into your ETFs. Are you still predicting an 8 to 10% gain for markets this year, or do you see them even higher?
Well, the U.S. was 10% last week. No, I think we have a potentiality for global markets to be up over 20% now.
20%?
Yeah. I mean, markets are improving. Economic conditions are improving. I think the changes in Japan is a net positive. China is not as weak as we feared. It's not as strong as we hope. And then you have the U.S. is going from strength to strength to strength, and so I think that could become the dominant story in 2013.
And you're bullish still on the U.S. economy?
I'm
very bullish.
I'm hyper bullish on the U.S. economy.
Because Gross just doubled his estimate. So what are you seeing?
Well, I never had to double my estimates. We always believed we were 2.5% plus economy, and if anything, we have migrated our views to a little higher. We didn't have to go from 1 to 3 or whatever.
But we're not close to 4%, which is steroidal growth in the U.S.
If it wasn't for Washington and the uncertainty that Washington has created, we'd probably be navigating close to a 4% economy.
Larry, we're going to continue this conversation after this, so we're talking get more from Larry Fink. Stay with us on First Up. Larry, let's talk about Japan, because everybody wants to talk about Japan. And given that this is Kuroda's official first day in office, are you enthused that Japan might be able to turn the corner?
So for 20 years, we always talked about Japan in a way that, oh, it's Japan, another year of deflation, another year of recession, and they could not break that 20-year cycle. And during this time, you saw a rise of its yen every year to extreme levels that got as high as 76 to the dollar. And at one time, it used to be over 200 yen, and then it moved down to between 100 and 120, and then we had this big shift. We're down. During that period of time, it was very difficult for companies to really make any money. They were trying to restructure their businesses. They were trying to cut payrolls. But more importantly, Japan lost its way because these companies had no profits and they could not reinvest in R&D. And so one of my classic questions I ask everybody in the audience is 20 years ago or 10 years ago, how many people owned a Sony product? And at that time, tens and tens and tens of people raise their hands. And today, obviously, it's much less. And that is to me, that's a metaphor of what happened in Japan. So what Japan is trying to do now, they're trying to reinflate. They're trying to say we can't live with this yen being so expensive. So they have now started to inflate. The yen is now in the mid-90s. And I think you're going to start seeing corporations earning some very large profits. Yep. But through those profits, you're going to start seeing an improvement in R&D spending. And the question is, out 2 or 3 years, are you going to start seeing those innovative products that we all expect from Japan? In the near term, you're going to see companies like a Toyota and other companies are going to have record profits, and they're going to start really rebuilding their whole factory chain line. So I'm very enthusiastic about what Japan is. The stock market's up about 20%. Yeah. But it's still the most underinvested equity market and underowned in the world. And also, if you hear the rhetoric from mainland China, it raises questions. Why are the rhetoric so loud so fast? Right. So to me, yes, this is significant. This is a change. And I'm pretty enthusiastic about Japan. Now,
let me ask you about levels, because people want to know where you see the yen trading, say, this year. What do you think the peak levels might be?
You could see somebody trying to push the yen to 105 to 110. I think it's going to stabilize around the 95 to 100 level. So I think we're close, but it could devalue another 8%.
Okay. And what about the stock markets? The Nikkei is up 20%, as you mentioned. We have Sony. Just to give you an example, a company that's up 100% on the year. Yeah. could we make much more money this year in Tokyo?
Well, I'm not sure Sony specific, but I do believe the overall equity market it was one of the markets where I would remain to be. I think there are very strong, innovative companies there that I think you're going to have an opportunity to find large investment gains over a cycle.
Well, but this competitive devaluation of the yen, I mean, everyone's talking about currency wars. You know, the Koreans are saying, well, look what this is doing to our exports.
Yeah.
And the euro yen, I mean, you know, Germany used to have such an advantage because of the weakness in the euro, not anymore.
But the anomaly was maybe the yen, not the other currencies, and how it's becoming back into a historical trend line. I don't think what Japan is doing is as significant as everyone loudly talking about. We've had, up until a few years ago, we've had China being considered a currency manipulator. I actually believe China has done a very good job of revaluing its currency, but for tens of years, China had a cheapened currency. The United States has followed that same practice. And I believe in the next 2 years, the dollar is going to revalue upward. So these are just 2 to 5 year trends.
But do you anticipate any, countries intervening in the markets? Because we've heard from New Zealand and the central bank governor saying he might have to if the Kiwi continues to be as strong as it has. But
you've seen last year you had Tom Beanie do it in Brazil.
Yeah.
I mean, these are currencies. This is a function of how their economy is doing. It's not the currency change is a result of interest rate policy. It's a result. It's not, I don't think it's a policy. We want currencies higher or lower. We are going to need to find ways to reboot our economies. We're going to reboot our economies by having excessive, easy monetary policy. One of the results of that is going to be a weakened currency. This is how monetary policy works. And we are in a very competitive world today. And we have excess labor markets in the world, and every politician worldwide needs to find ways to improve their country. And so we're in this world right now that's very competitive. I would tell you, though, despite all this, I think one people should understand, wages are becoming less of a factor in the competitive world today. It's going to be all about commodity prices, energy prices, and that's linking to the United States, that's where we have an advantage. Yeah,
well, let's also talk about China. Speaking of competitive and improvement, because we have a new leadership in place. In fact, you're on your way to Beijing later on during your travels across the Asia-Pacific. Have you met the new leadership in China?
I have not yet, but I will see if I do.
Are you encouraged by China? Because we grew, I think, at a 13-year low last year. You have a new chairwoman also for BlackRock in China.
Yes, we do.
Does that mean that you're looking for more business in the country? You're enthused by
We're very enthusiastic about what's happening. We think there's going to be great opportunity. We're anxious to hear from the new party leadership as to how they are going to navigate their economy. The question will be, will they liberalize parts of their economy to unlock some of that massive savings? The Chinese now are saving anywhere between 25% and 35% of their disposable income, and they're doing that because there's no safety nets. We have healthcare issues. There's no retirement issues, so they're saving a large sum of that money. Most of that money is sitting in bank deposits. Yeah. So the question is, will the markets be liberalized to allow the Chinese to start investing in other products? And if that's the case, will there be opportunities for non-Chinese companies to have? And
what is the best bet in China? Is it playing on the currency, the yuan itself, or?
Well, I think the yuan is fairly valued. And if you use some indexes, the yuan is actually a cheap currency today. And so, no, I think there's going to be opportunities to invest in Chinese companies as we strengthen corporate governance, as we have better IPO process in China. There are some wonderful, strong international companies in China that will be leading the world in the future. We just need to be more comfortable on governance, and we need to be more comfortable about where the economy is going. Okay, so my producer is saying we got to revisit what took place exactly at this table a year ago. And did you think it would go all around the world as it did, your call? Let me play it for you. I've been pretty consistent on this, and I started this off probably in August last year, be 100% in equities. I don't have a view that the world's going to fall apart, and so you need to take on more risk. You need to overcome all this noise, and there are great values in equities.
Okay, there you go. So it's at 100% in equities. And when you made that call, I mean, everybody picked it up saying, Larry Fink is saying, be 100% in equities. Do you still feel that way?
Well, the markets are up 31% since that call, and bonds are up a fraction. For men and women who are 35 years old, interested in building a nest egg for their retirement, they have no choice but to be 100% in equities. I think the greatest mistake we have in the world today is the underappreciation of longevity. We're all going to live longer, especially in Hong Kong. I mean, we are going to have great longevity. Owning a bond that's paying you 1 or 2 or 3% just is not going to provide you with the nest egg out 20, 30 years. You know, if you're 65 years old and you are on a fixed payments, yes, bonds are a wonderful investment. But the reality is we need to be thoughtful about what our objectives are. In the world today, we see so much retirement going to defined contribution. What we are witnessing when men and women have to make their own investment choice, they tend to make it too conservatively. This is why we've seen such a rush into bonds, because they're frightened about the world economies, they're frightened about all the noise, and so they're putting a huge allocation in their retirement in bonds. And unfortunately, if your liability is out 30 years or 40 years, you will not have the appropriate nest egg.
But what about diversification, just in case?
Of course, you should have diversification.
You should be holding some cash, maybe some gold bonds, something like that.
Yeah, no, look. I'm trying to make a more of an outright statement that we need to focus on equities. I'm all in favor of diversification. There are some great investments in credit. There are, you know, people should definitely have money for the rainy day, so in cash. But what I'm trying to just alarm people, if you don't start focusing on the needs you have out 30 years, you're going to have an inadequate retirement. And all those people are then going to be a burden on the children, because they're going to have somebody to help them.
Right.
And this is one of the reasons, getting back to mainland China, why such saving rates are so high. Because all that money is going into bank deposits, not earning much money. There is no safety net, and as a result of their building this nest egg, but having that large of a component of money going into savings, the economy is not growing as fast as we expected. You're not seeing domestic consumption as fast as we wanted. We have the same problem worldwide. We are not building the adequacy of retirement, and that's going to be the biggest crisis in the world in 10 years. And so that's why I'm alarming people by saying be 100% in equities, because for those who do it, I think over a 20-year cycle, they're going to have a better opportunity of having the adequacy of their nest egg than those who are sitting a majority of their nest egg in cash.
And they buy BlackRock ETFs to get into those equities.
They could buy anybody's product, hopefully ours, but I'm not going to proselyte that. All
right. Okay, one more question for you before I let you go. I know you're very busy. But what about the BlackRock story yesterday? You know, cutting 300 jobs around the world. Is that more natural attrition because it's only 3% of your workforce, and you're going to have more headcount than at the end of this year than you did at the end of 2012?
Historically, we've done just natural attrition. We decided to do it once instead of having just a few people in this division, a few people in another division. We have grown 15% of headcount since the BGI merger. We probably added more jobs than almost the entire industry by itself. So, you know, we've added
18% of your workforce since the end of 2010.
Right. So we've added a lot. We're going to be up another 500 people this year.
Yeah.
We just thought it would be best to just do this once and take the charge right away and move on and help everybody to find another job. In our employee surveys, one of the employee surveys that we had internally at the end of the year was people who were, you know, young and upcomers. They're saying we want more mobility, we want more opportunity, and so, in other words, we need to make sure that we have a lot of up-and-comers having opportunities, and we thought this is the easiest way for us to navigate this. There's some firms that do annual calls of people. Philosophically, I'm against that. I don't want that to be part of our culture. But we determined to get this done instead of a slow attrition, and let's just move on.
Okay. So if your headcount is going to be more at the end of this year than it was at the end of 2012, are you hiring out here in Asia? Because you were building up Singapore and Hong Kong for a while.
We will have a net hiring about 500 people. So we're going to have to if you think about the people who are asked to leave, plus that we're going to have to hire 800 to 900 people between now and year end.
Right. And how many of those people will be in Asia, do you
Probably
think?
about 20% between
Wow.
Asia and Australia and Japan.